Good morning, everyone. I'd like to welcome you back to the Peterson Institute for International Economics and also to welcome our friends and fans viewing online. People will be continuing to come in, but I wanted to get us started out of respect for our lead-off speaker's demands on his time this week. I'm Adam Posen, president of the Peterson Institute, and it is my distinct pleasure to held the latest in our semi-annual series of sovereign economic panels that we do jointly with Moody's Investor Service. These tend to be very high substance events, bringing together analytics from a markets perspective, analytics from our perspective, people from the official sector. And we have a particularly good version of that today, focusing on Europe, representatives from Sweden, central bank and the finance ministry embodied in one person. Later today, we'll be having all of our friend Vitor Gaspar from the fiscal department of the IMF, and of course, former finance minister of Portugal. But we start off today with the question, we've tried to put out the title, the EU challenged and poised for change. That this is a time when, God willing, we hope the crisis, and European Commission willing, the crisis is abating, but that there are clearly new macroeconomic pressures bearing down on the European project and on the euro area. And clearly there are also, with the election of the new commissioner, the new team of commissioners, the new European president, the new European cycle or semester, I think Jacob has taught me to say, there's a new agenda and a new spirit in Brussels and elsewhere. So this is a very exciting time for Europe, we hope exciting in a positive way, and no one could be better poised to talk about that than our keynote opening address by Marco Buti. As all of you know, no doubt, Marco Buti has been Director General of Economic and Financial Affairs, ECFIN, at the European Commission since 2008. So he came in just in time for all the good stuff. He, of course, had previously spent the previous 21 years at the Commission in a variety of roles. He was an economic advisor to the Commission's president until 2003. From 2003 to 2006, he was Director of Economies of Member States, obviously the most sensitive position, at the Director General ECFIN, and he was Deputy Director General in September 2006. He has his degree from Oxford. He's taught at a number of universities. He's a longtime friend of the Institute and has always responded to the both support and criticism that we and others have offered in a calm, engaged manner. But I really look forward to him putting out his agenda and his vision at this point of challenge and change for the EU. So, Marco, thank you so much for joining us.
Thanks. Thank you very much. Okay. No, thank you very much, Adam. Let me thank the Peterson Institute and Moody's for having organized this, for inviting me. Lucius here, Adam. We are, as Adam said, at a crucial juncture in Europe. Actually, we have been at a crucial juncture now for a couple of years. Every time we come, we'll say this is really the moment. But we are engaged in what one can call, let's say, a triple transition. I mean, we have a transition on the economic and financial front, basically moving from a period of acute stress to challenges which relate mainly to the avoiding the risk of erosion in terms of economic performance and also social sustainability. This is, let's say, is the first transition. There is an institutional one. Adam referred to that. I mean, we're going to have a new team in Brussels, a new College of Commissioners, and a new President of the European Council. So an opportunity for a fresh start with a strong endorsement of the President-elect Juncker on the part of the European Parliament following the European elections. So tackling somehow the democratic accountability issue that is often discussed in Europe, and we are in the process of going through the hearings in the European Parliament for the appointments of the new commissioners. Yesterday was an important day because the economics team at the college level, Mr. Moscovici, Lord Hill in charge of financial regulatory issues, and the two vice presidents have been formally endorsed by the European Parliament. So an important moment. The process is now finished, but let's say we are reasonably optimistic now that the new team will be in office on the 1st of November. So this is the institutional transition, and then we have also a political transition. We clearly see that in a number of member states, even just take the largest ones, there is an important debate on the orientation for economic policies, and let's call it like this, the reformist credentials of the governments in Italy, in France in particular, I think are being tested these very hours in a sense. So for different reasons, I think it will be it's a crucial passage to something which would make the overall policy stance and policy strategy in Europe more consistent, adequate to tackle the challenges that I'm going to talk about today. I think the key word already in the presentation of his strategic guidelines, I'm talking about President-elect Juncker in Parliament, has on the economic agenda side revolved around investment. So I would like to go through with you the challenges related to investment, and you can see that through that we come also to the issue of, let's say, the growth model that is, let's say, the title of this conference. So we're going to look at the impact of the crisis on investment, the underlying factors hampering investment, and then the possible policy avenues to tackle these issues. I think what you can see here is the behavior of GDP across the Atlantic, so focusing on the euro area and the US. So the type of recovery that or non-recovery that we are witnessing in Europe. The past recovery here is, I have selected an episode which is the beginning of the 90s, because it was there again a very severe shock. And what you can see is that for the US there is relatively parallel behavior between the present and that episode there, whilst for the euro area, after the recovery, which was indeed similar in the initial quarters, there has been stalling then. I mean, President Draghi mentioned this also last week, qualifying it as loss of momentum in the recovery. You can see that this is clearly a pretty unsatisfactory behavior that we need to tackle. And by the way, when it is not that the benchmark of the US is a particularly stellar one. I mean, discussion on this side of the Atlantic is also of a muted recovery. So here again, it's not that the benchmark is set so high that we cannot meet it. Now, I come to investment because I think a lot that underlines the performance or the lack of performance of the previous slide is very much related to investment. Here, I have selected equipment investment, taking away the housing because we know that biases the picture, considering the irrational exuberance, let's say, of the pre-crisis period across the Atlantic in the US, but also in a number of European countries. What is interesting to see here is that when the shock of the financial crisis hit the real economy in 2009, if you focus in the last two lines, you can see that the US and the euro area actually were hit exactly by the same amount. So there was a fall of investment by almost 20%, the same across the. Obviously, there is a bit of differences within the euro area, but by and large, the shock was similar. What has then characterized the following years is a recovery which is reasonably robust in the US, but here again, let's say the considerations on the benchmark that I made before for the GDP applies also for investment. You think if you talk here to economists in the US on the performance of business investment, they tell you that it's a very muted recovery. So again, one should put things a bit in perspective. But what you can see clearly is that you take the following period till 2013, there is basically almost no recovery in the euro area and quite robust recovery in the US. These are figures which come from our spring forecast, so back in April, where we were, let's say, reasonably optimistic that the recovery, though fragile and muted, would be underway. So the forecast for 2015 reflected that reasonably, let's say, cautiously optimistic mood. When we are going to come with our forecast of autumn, which is going to be published in the first week of November, we are going to see these figures revised down because the recovery is has clearly proved more complicated and even less buoyant than these very moderate numbers. Now, the focus on investment is, in particular, investment in equipment is attractive because it has both a supply side and a demand side component. This helps also politically because we all know that in Europe in particular, though some countries are more sensitive to the, let's say, short-term cyclical considerations, so the impact of investment in order to, say, to close the output gap. Other countries, they are much more concerned about the longer-term performance, and equipment investment actually affects, investment in general affects both supply and demand. What we have here is our estimates of with our production function of the implications of the fall in the ratio of investment to potential output onto potential growth. Basically, what this figure tells you is that the 3 points reduction in the investment to GDP ratio, which occurred during the crisis, has slashed almost half a point of potential growth. Here we have, with all these models, somehow there is means reverting, looking forward. So this has to be taken with a certain caution. It's not that everything will go back to normal without the policy action. But this is the picture that we have now, and the impact of the fall in the investment ratio. Clearly, what you can see here is in the pre-crisis period, there was a spike of investment, and some of the elements I'm going to come to in a moment, which are behind the deleveraging that you can see, are also related to possible overinvestment in a number of countries in the pre-crisis period. What you can see in this picture here is that the situation is pretty differentiated across the euro area. Here we have the euro area average and the subset of stressed countries. So we take the vulnerable countries, we have Italy also in, And what you can see is that in the pre-crisis period, the investment ratio was considerably higher in what have become stressed countries. And this is also related to the fact that these countries were in a catching-up period, so it's normal that you have a higher investment ratio compared to the others. And you can see the investment precipitates quite substantially during the crisis. And so the fall that you observe in the euro area average is considerably steeper in the case of vulnerable countries. So they have taken a hit which is much stronger than the other countries. Now, what are the factors underpinning this? What explains this performance of investment? I think I have listed here, and I tried to document briefly 5 possible causes. One is Economics 101 accelerator, so the link between investment and demand. The second, what I alluded to a moment ago, the need of deleveraging in a number of countries and the reduction of overcapacity in pre-crisis booming period. Financial fragmentation, I mean the type of consolidation that we have observed, and finally, more contested, the issue of the implication of uncertainty on investment. Now, going through this, here is the impact of the accelerator. What you can see here is that the accelerator model fits Europe reasonably well. Obviously, when we talk about the accelerator, we have to be careful in not let's say, establishing or being, let's say, too sure about the causal link between investment and demand, because the two things are closely interconnected. But clearly, the fact that you do not have growth prospects coming forward, having this come down, reduces, let's say, the trend equilibrium level of investment. On the deleveraging side, this is a pretty striking picture. You can see that what I have here on the x-axis is, and on the y-axis, is that on the x-axis you have the change in the debt on non-financial corporations essentially in the pre-crisis period. It goes 2009, but so the debt accumulated then. So the more you have accumulated debt, then the more you need deleveraging in the post-crisis period or during the crisis. And you can see on the y-axis the change in non-residential investment. You can see a very, very strong negative correlation. So those who have been affected most by irrational exuberance in the pre-crisis period, the more have witnessed a slump in investment in the subsequent period. I think we jump this up. We'll go to the third element, which is financial fragmentation. In Europe, and here there are different measures, but what you can see is that we hoped by creating economic and monetary union, the euro as a supplement to the as a coronation, let's say, of the internal market for financial services that would lead to a convergence of credit and borrowing conditions, and this has happened to an extent in the pre-crisis period, even too much in a sense, and then during the crisis, financial fragmentation hit the euro area, and you have countries like Italy, Spain, Portugal, not to mention Greece here, which would go outside the y-axis. They have clearly suffered considerably and have seen credit conditions diverging substantially, and which has certainly hit the investment prospects via especially SMEs borrowing. What has been done on the public investment also has an impact. Here what you can see is the G20 and within Europe the EU coordinated fiscal stimulus. It has been quite substantially boosted in 2009 via the coordinated fiscal expansion, but then public investment has been retrenched very strong, pretty strongly in the following year. So this also has had an impact on public on investment tout court by reduction in public investment. So the type of consolidation, the quality of public finance has been hit by by cutting, where at the end of the day it's easier when you do the coordination, which is on the investment side, rather than tackling the vested interests which are behind the behind other types of public spending. And finally, I present here a graph on behavior of investment and uncertainty. This is the uncertainty indicator computed by Nicholas Bloom and Ali at Stanford, and you can see there is a pretty strong correlation, especially during the let's say the crisis period. This has uncertainty has been reduced in the past few quarters. So one could expect that this factor here, compared to the existential uncertainty in the midst of the crisis, that would then recede, and the impact on investment becoming, let's say, less important. There is a discussion out there of how robust this is in terms of an explanation for the behavior of investors. Some say that, okay, it is the causality goes the other way around. I just presented here. This is seems to be pretty robust for the euro area as a whole and for the European Union. When you go down and look per countries, the relation becomes less convincing. So these are, by and large, 5 elements which underpin the behavior of investment. So when you come to the policy agenda, at the end of the day, the issue is, how to tackle each one of those underlying reasons. So for the policy avenues, this is what we are working on. There is an issue here of demand. I think after a long time where it was this was a pretty dirty word in Europe, I think there is acknowledgement that demand is there. It's an important factor to put the accelerator into reverse. We have to work on structural reforms, in particular on product market reform, to unlock investment opportunities. Financial fragmentation by completing banking union. I think also by improving access to long-term finance for investment, to reduce the excessive weight of banks in Europe. Here, the proposal by President Juncker, which has been outlined in this speech at the European Parliament, to move towards a capital market union, I think is a far-reaching one. When we come to public finances, I think there is a need to boost investment where there is room for maneuver, and where there is sufficient fiscal space. Boosting investment, I think, is important by using this fiscal space. For those countries which do not have fiscal space, I think the issue is composition, reviewing the composition of public finances, public expenditure in particular. You all have seen the chapter in the World Economic Outlook on, they say, self-financing public investment. Not ready to buy fully that those, let's say, the Laffer curve for public investment, but certainly it indicates that the conditions out there are highly conducive to stepping up public investment, investment infrastructure, especially when you see example of decay in the capital stock in a number of European countries. And I'm talking about the Europe, but there is a discussion and an agreement also at the G20 level, where in preparation of the Brisbane Action Plan, investment is going to be one of the key pillars. So action is needed at national, European, I think a global level, and I think moving several levers at the same time would be the right strategy at this juncture. So what could be done at the national level? I think we need to have a more balanced adjustment. Here, growth-friendly fiscal consolidation to increase public investment using the fiscal space where it exists, as I mentioned before. And on the structural reforms, implement here got a bit in the jargon, the country-specific recommendations under the European semester. So it is the cycle of coordination and surveillance that we have in Europe. On the fiscal side, I think here basically says what I have indicated. Fiscal stance overall becomes considerably more neutral than it has been in the past couple of years, so less drag from fiscal policy at the present juncture. I think the possibility also to improve the impact on investment by reviewing the composition of public finances, taking into account that debt, you see it on the right-hand side there, is at high level and is not projected to come down, I think, anytime soon in earnest. I think we also have to move on structural reform side. Here you see indicators of proto-market reforms using OECD data and strictness of EPL. I think the main message from this is that the degree of reform responsiveness is much higher in peripheral countries than in large euro area member states. This is in part due to the fact in some of these countries we had EU IMF programs. We pushed precisely those structural reforms, but certainly is only with countries with shoulder against the wall that reforms have been implemented. Much less for countries in a more relaxed position, and here the degree of reform responsiveness is definitely lower in countries like France, Italy, but also Germany. Not much move you can see on the labor market reform side. On the part of core countries, you can see improvement instead in peripheral countries. So this is also the direction where to go in the next months, and actually this does not capture the recent discussion that you have in countries like Italy, where I think there are important and ambitious reforms in the labor market, which hopefully will be implemented soon. These are the recommendations that we are issuing, and they tackle a number of these matters. I don't want to lose time on this. At the EU level, the approach that we are taking in designing the Juncker investment package, which the Commission will issue as soon as the new college takes over, so in the next weeks, I am expecting before the end of the year, is to have a pretty comprehensive approach to remove the regulatory bottlenecks to investment. Here, the focus is going to be essentially on investment in network industries, telecoms, transport, energy, and we know that sector regulatory barriers that hamper investment. We have to make better use of the available resources and boosting them, EIB in particular, European Investment Fund as well, better harnessing the EU budget, improve the access to long-term financing, and also the completion of banking union to deal with financial fragmentation. I mentioned there also the ECB because at the end of the day the macro picture has to be consistent and clearly with if we get stuck in a very low inflation equilibrium, I mean the rest is not going to come through even with some active push on the part of the European authorities. And finally, at the global level, this is the discussion in G20. Actually, as soon as I finish here, I have to go back to the G20 deputies, and I apologize already because we are discussing precisely this point here, and I'm lead speaker, so I cannot dump them. So there is, in the Brisbane Summit, the G20 aims are coming forward with an action plan which has, I think, in investment a key component. The objective is to lift collective GDP by 2% above the trajectory implied by the current policies. We are now, together with the OECD, with the IMF, trying to push countries and to into more action to achieve the objective of the 2%. And what is going to come out from the Brisbane Summit is an action plan which we are pushing for making it to make it considerably stronger than what was decided last year in St. Petersburg, and trying to offer also the example of the coordination and surveillance that we have in Europe to make sure that it is not simply a bottom-up of number of announcements which are forgotten as soon as they are pronounced, but there is we put in place a system of peer review and a monitoring device which monitors indeed what member states, G20 members will do in the next year, very much pushed by the Australian presidency, also the creation of a global infrastructure center, which is being discussed at this very moment. I think this is the whole picture. As you can see, the angle of investment is taken, and I think it is the right way of looking at it, taken in order to broaden the policy agenda and to see this as a trigger for prompting the right macroeconomic policy stance, the right micro and structural reforms stance. I think it would be problematic if we just look at investment by selecting one specific angle instead of having this comprehensive view. And through this comprehensive view, clearly, you will get also to the growth model that will have to be fundamentally reshaped in Europe if Europe wants to prosper and get out of the hole in which we are at the moment. Thank you very much. Yeah, okay. Yeah, please. Sit down.
Yeah, please. Thank you so much, Marco, and I want to commend you and your colleagues in DG ECFIN because the genuine intellectual shift that you made oblique reference to, that not just about demand, but about the importance of public investment, the differentiation of different forms of investment and spending, and I think perhaps as critically, the shift to thinking about structural reform as not being just labor markets in the stressed countries, but product markets throughout Europe. I think these are things that obviously you and your colleagues have been building towards, and I commend you for moving the debate in that direction. We have a very good audience. I want to turn it over to them for questions since you do have giving us generously a bit of time. But let me just ask one question to get us started. When we look around the world right now, so I'm now going to go very much opposite to where I think you're going and where I personally am, but just for the sake of argument. When we look around the world right now, corporate fixed investment is down everywhere. Dave Stockton gave his analysis and forecast for the U.S. economy for us last week, and we stressed the fact that we're still waiting for corporate investment to rebound in the U.S. as well. It's very easy to explain why public investment went down in recent years. But once we get beyond, say, 2010, 2011, it's less easy and evident to say why corporate investment has been unresponsive to easy monetary conditions, low asset prices, and so on. Especially since the US and the UK, for example, have companies sitting on huge piles of cash. Just analytically, how do you think about this? I mean, if we take what you're recommending, it seems to be addressing the structural failures in capital markets in Europe, which I think is a perfectly sensible thing to do, but that doesn't explain why we've seen outside of the euro area and around the world the paucity of private investment. How do you think about that?
Yeah, no, I think, well, first of all, let me thank you, Adam, and the Institute, Moody's also for the present event and for the continuous intellectual stimulus that you have provided to us in a very critical way, which is the name of the game. And I always use you as levers to convince my political authorities. So I think this I'm count will continue. It will definitely continue in the future. I think it is true that, and I mentioned it en passant when I presented my slides. When you compare the investment performance in Europe with that of the US, I qualified. I mean, the benchmark has not been, an extremely buoyant one. So that we are. So there is an issue, I think, overall. I think if one takes an equilibrium view of investment, we have done these analyses ourselves. And if you project lower growth in the future, then you can also have the equilibrium investment, which is lower now. I mean, actually, there are some analysts you take. I think Daniel Gross has come forward with a recent piece who actually argue that in the light of this, there is not much of an investment gap in this. So this element here, I think, has to be taken into account. So the equilibrium investment. It does not mean that the equilibrium investment is a desirable level of investment, because I mean that would imply accepting that you go down, to shift to a lower trend growth. That would be something that is acceptable. Why it is not acceptable in the light of what we have. I think a number of elements which affects here. I use the uncertainty indicator, but one can break it down in a more explicit manner. But even lately, take for a number of countries in Europe, I mean, the impact of the geopolitical crisis, the uncertainty, Ukraine, etc. It's pretty evident in those conditions that the situation is not conducive to higher investment. There is also an issue, and I think on this, I think more work will be needed, and I would welcome very much input on this. Clearly, different countries, both for private as well as for public investment, manage to extract more growth out of a certain level of investment than other countries. I mean, I mentioned the World Economic Outlook and talk about public investment. There, let's say the self-financing investment that you have is in the optimal situation in which you have no waste. Or if you go to instead, investment which is less profitable, clearly you have much less of an effect. I think the same applies, I think, and even more in a more pronounced way for private investment. One, and you can see, for instance, you take Germany in Europe. It does not have a traditionally high investment ratio, but it manages to, let's say, to make most of it much more than other countries with higher investment rates. And what I think is my final word, what you have there also is the issue of reviewing the investment strategy in the light of the global production chains, which imply that you not necessarily invest in your country. This for Germany is typical, but you invest very much abroad. Then the question would be, how to make investment in Europe, more profitable, and what are the conditions in order to trigger that? And maybe a number of policy avenues that I have depicted could help in that front.
Great, very thoughtful. I just picking up on your mention of Germany for a moment, and you had said in your slides about the idea of those countries having room to increase investment, doing so, public especially. Just could you say a word about how the fiscal compact and the surveillance process as currently constructed and reconstructed in Europe will push some of those countries to take up expansionary policies or not? I mean, as you're well aware, people in this building but elsewhere have always worried about this being an asymmetric fiscal compact, and I was wondering your thoughts on that.
I was expecting something of the sort. Now, what we have in Europe are rules. Let's put it like that. They are rules of a proscribing nature, not of a prescribing one. So the logic of the Maastricht Treaty, which has then been embodied in the Stability Pact, is what the treaty says, avoid gross errors. And there, the frame of mind that the fathers of the treaty had, reflecting also the economic thinking and literature at the time, was that when you move to a monetary union, you have a natural deficit bias. So they wanted to rein in these temptations for excessive accumulation of debt and high deficit. So they proscribed a number of behaviors, but they did not prescribe. Now, we have made some steps in the direction of a more prescribing nature of fiscal rules by the kind of country-specific recommendations, which I briefly talked about there. But it is clear that the country-specific recommendations they are more of a soft coordination sort rather than the hard ones which are embodied in the fiscal compact and in the excessive deficit procedure. Now, what we can see and this is the case of a number of surplus countries, is more on the power of, let's say, persuasion and, let's say, talking about the political economy of this. And I would see a link between, let's say, the kind of structural reforms strategy that are badly needed in the case of Italy and France to boost competitiveness and productivity, and the kind of accompanying role that stronger demand in Germany would have. One could look at, in the case of a number of surplus countries, is what kind of room for maneuver they have under the fiscal compact and under their own domestic rules, because you take in the case of Germany, they have to abide to the European rules, fiscal compact, 6-pack and 2-pack, so the stability and growth pact in Europe. But then they have also some rules at the constitutional level with a debt break. And so one should look at to what extent, there is room for maneuver, let's say, without necessarily violating the self-chosen rules. And we consider that in the present juncture, in the light of the need to reinvigorate demand in Europe, there should be more action on that front.
Brilliant. Thank you. Let me open up for questions. Just to recap for people, we have a moving mic up front, thanks to Jessica. We have a standing mic at back. I'll recognize you when I do. Please state your name and affiliation so we know who's speaking. But first, let me go to our co-host.
Thanks for that, Adam. Allow me to start by thanking Marco for kindly accepting the invitation for the event. Marco, if I can go back to the questions that we just addressed concerning investment, public investment, etc. I do think that the question that Adam just posed, which effectively is if we seem to have a glut of savings at the private sector at a global level, half of the factors that you mentioned that may be seen as global, but the bulk of them effectively are European ones. They do not really serve as an explanation why do we have this apparent glut of unused investment sources in the private sector in the United States and in Japan. This for me is still very much of an open question. You can make the case that you have expectational questions that are global related to how the global economy is going to be performing in the future, but this then deserves a more global explanation than the European specific factors that you just mentioned. On the questions of investment and investment in infrastructure, allow me to add a certain note of perhaps warranted skepticism here. I, as a proud Portuguese citizen, right, I come from a country that you can make the case that didn't have the same sort of a real estate bubble that arguably we had in Spain, but I think that you can make a case that we had a public investment infrastructure bubble. We are a country that has a higher number of kilometers of highways per capita now than in Germany, right? When I was born, there was only one highway in Portugal, so you can imagine the implication of this increase. Now, as you pointed out, the effects between growth and investment are not necessarily linear. Germany seems to have a very large amount to derive a great elasticity of growth from the existing stock of GDP, the existing stock of public infrastructure. So just by assuming that we are going to increase investment in infrastructure doesn't necessarily imply that we're going to have the growth effects that one might expect. Also, when you frame the argument that certain member states may increase their investment, we are effectively framing this not only in terms of Germany would need that, but in terms of the knock-on effects in terms of the periphery, which is a different story, right? The Germans could still have a reasonably sustainable medium-term growth path with their current stock of investment and investment in infrastructure. If we are framing the question in terms of the supply push that this is going to have for the periphery, this is a slightly different question. Okay?
Shall we take another question? No,
it's up to you. Do you want to
no, I mean,
respond to that,
yeah, maybe let's take another couple
That's
of...
fine.
yeah.
So great. So Jacob, could I ask the lady in back to go to the standing mic? Thank you.
Jacob Kierkegaard from the Peterson Institute. I was wondering, Marco, if you could walk us through your views on the political economy of structural reforms in Europe, because it seems to me that that's sort of at the heart of also generating, you know, and a broader climate that's conducive for private investment. You mentioned that seemingly countries that have their countries against the wall, that are under programs, seems to do more reforms than countries that are not. Now, the immediate policy implications of that would be that actually, if you're the central bank, you conduct a monetary policy that is perhaps too tight. And if you are the fiscal surveillance authorities, aka the Commission, you actually do not give countries additional fiscal space. And the idea that somehow that is articulated in some of the policy advice from other institutions of this nature, that somehow you can bribe countries to do structural reforms by giving them, you know, additional fiscal space, is actually, you know, pushing in the wrong direction. Is that how you think about it, or how should we interpret the recent moves by the Commission on this issue?
It's up to you. We can take one more question.
But maybe let me take this too. Okay, first of all, I think the points that I made before on the quality of investment is absolutely key, and I have to say I fully agree with you on the fact that in Europe, in Southern Europe, you mentioned Portugal, but you can take Spain also, and you try to assess there the, let's say, the amount and density of infrastructure compared to other things, I mean, is probably over the top or any reasonable equilibrium. So I think this is it's a good point, and that's why also we are trying to struggle, and I have to say with a certain difficulties in the context of the G20. So the meeting just a few blocks away, on the fact that we should look at the investment not only from the point of view of infrastructure and material investment also, but the immaterial one. So the investment in, let's say, human resources, R&D, etc., being as important. I have to say there is a lot of pushback there because the emerging economies they want put much more emphasis on material investment, and Australia as well as the chair of the G20. So I think this element here is important. So we'll need when designing the Juncker package, which will come, as I indicated, in November, December, we'll need to pay due attention to this element as well. It has, I think, an important consideration also as a qualification of the point that I made at the very beginning of, let's say, investment being helpful when it's well done, both on the supply side and on the demand side. Clearly, if one has more of a concern about the demand side, then you may want to do more on the material investment, which is, I think, it has higher multiplier in the short term.
Yeah.
If you think more about this, let's say, supply side considerations and link with total factor productivity, you may want by pushing the frontier work more on the immaterial investment side. So I think this is things that one will have to take into account, but I think your point is well taken. Now, on the point of the political economy of structural reforms, I think here there are two views in the literature. I have written myself also some in the past, both on the theory and the empirical evidence on structural reforms. There are two views, basically. One is that when you're thinking about structural reforms and, let's say, fiscal discipline, there are those who emphasize the substitutability between the two, and those who emphasize the complementarity between the two. I mean, basically, the substitutability is that if you give a bit more leeway, then this leeway can be used in order to compensate the losers, which we know are there in the short term for certain types of structural reforms. So you give incentives to do more structural reforms. This is the substitutability view. And the complementarity view is that it's only when you have indeed you are pushed and you are stirring to the abyss that you decide, you find the political courage to do the structural reforms. In this case here, being shoulder against the wall would help to trigger the structural reforms given the hardship. Now, the theoretical analysis and the empirical with pre-crisis evidence that we found in this paper was that a key element which plays in determining whether the complementarity or substitutability story holds is the time horizon of governments. So for those governments which have a longer time horizon, then the substitutability story, I think, plays more. For governments which are myopic, and there we measure it by distance to the next elections, I think the complementarity story I think helps. And I think this is, by and large, it makes sense. Now, the question is that what happens during the crisis, and what is the evidence there? I think the evidence is definite. Complementarity wins, and it is shown by the graphs I mentioned before. I mean, the reforms are done only under hardship, either because of financial market pressure or because there is a helping hand by the IMF and the EU pushing the countries to do so by more stringent monitoring. Now, I think if one looks to the future, there is the debate on the flexibility of the Stability Pact and how to, within the exiting rules, having some more room for maneuver, would be to establish, let's say, a monitoring system, a commitment technology which would allow by, let's say, to revert more onto the substitutability element, whilst preserving the key rules of the Stability Pact, because they don't want to change the rules again. Clearly, Germany is skeptical about this, and I think the examples that they have in mind are essentially two, and I think they are well taken. One is summer 2011, Italy, Berlusconi's government, and launch of the SMP program by the ECB, commitments upfront by the government at the time. ECB starts to buy Italian bonds, commitments put in the drawer and forgotten. The other more recent example is, let's say, the 2 additional years given to France, basically last year, 18 months ago, commitments to use these 2 years to accelerate on the structural reforms. The first reform that came through was on the pension side, and let's say it was half-baked at best. And we know, and the French government also acknowledged at the time, I will have to go back to the pension reform. So I think looking forward, since we do not want to have a masochistic approach and try to put countries in trouble to make sure that they reform, we will need to have a clear agreement, a clear political commitment to make sure that the reforms are implemented. In the pact, there is a specific clause which, for countries not in excessive deficit, you can have some leeway for structural reforms, but we insist very much on structural reforms being adopted, not just, vaguely announced, to make sure that this commitment sticks.
Terrific. I will resist the urge to go deeper, just commend you on the blending of research and experience, and we'll look forward to debating that in future. Please, if you could go to the mic at back.
Thank you, Mr. Buti, for a very informative speech from the World Bank.
What's your name, please?
Oh, Rumin Islam.
Thank you.
So you listed a number of factors that are affecting investment rates, and I was wondering whether you could talk a little bit about different types of countries, because they vary a lot, particularly if I look at some of the emerging economies. They vary a lot in terms of what might be the most important factors in these countries. For example, you mentioned decline in public investment rates, and which differ across countries. You mentioned the financial fragmentation, which one of the results of which is SMEs not getting credit. So if you could talk a little bit about perhaps country typology, that would be very interesting. Thank you.
Do we want to take one more question? Yeah, the gentleman there.
Good morning. I'm Arturo Porsekansky with American University. I gather that the Commission and France don't see exactly eye to eye with regard to fiscal policy. And so I was wondering, for those of us who are not insiders like you are, what has changed, would you say, for the better, for the worse, or not at all, between the Commission and individual countries, especially those of significance, with regard to the analysis of fiscal policy and measures to implement some kind of discipline?
Before Mark...
Yeah, before 2008 and now, let's say.
Thank you. Before Marco responds, I just want to say those will have to be the last questions. As you can see, not just from the 2 badges he's wearing, but from his intellectual engagement, he truly is at the center of the public discussion right now, and he's been very generous to give us the time he has. So, Marco.
Yeah, I think two not very easy questions. I think if we take the 5 elements that I have listed in my slide from the accelerator, the deleveraging needs, financial fragmentation, the public investment reduction, and uncertainty. I think you can quite easily map it out to different situations of the countries. I have done this exercise essentially from Europe in my backyard, but maybe one could apply that also more globally. It is clear, for instance, that when you come to financial fragmentation, the countries which you can see in the chart having quite considerably higher interest rate and less favorable lending conditions are more affected by that. When you come to the impact of uncertainty, I have to say I've written myself on this and had a little bit of controversy with some of criticism on the relation between uncertainty and investment, but I think one can be pretty safe in concluding that if you take uncertainty in the midst of the crisis when the euro area faced existential threats, I think there is no doubt that if you do not know the next day in what currency you are going to be repaid, you don't have much incentives in doing investment there. And I think on the accelerator thing, I think this is pretty uniform across Europe, considering, however, that the domestic demand has slumped maybe in a bit differentiated way. So I think this mapping can be done, and one can attribute, let's say, the relative weight to these and possibly other reasons. On the view on fiscal policy, I think one can go back to what I indicated before, namely the prescribing versus proscribing rules. I think the current set of rules that we have is, or which is of the proscribing nature, I think works well has a chance to work well in more normal times. When you come to crisis times in which you would need also a bit more active policy, I think it has to be complemented by some more, let's say, forceful recommendation. Also for countries which have, let's say, the fiscal space. What we are witnessing in Europe is that there is, in a sense, less willingness to use the fiscal space for countries which have it, and countries which do not have fiscal space, they want to use it, but they don't have it. So I think the discussion on that front will, I think, continue in the next weeks. I see also as let's say, as a way forward here, a strong support for a robust and credible package at the European level. So what comes out from the Juncker Commission in the next weeks will be important, because doing things collectively at the European level also allows to, let's say, to find some space which at the member states individually cannot be found.
Well, thank you so much, Marco. As always, you're not only gracious, but you're so deeply engaged at all levels. And it is always a privilege for us to interact with your colleagues at ECFIN, but in particular to have you come and interact so deeply with our audience, so frankly and so thoughtfully. If I may, I'd just like to say we thank you for your extraordinary service over the last 6 years to Europe and to the world. And we wish you and your colleagues the best with the Juncker investment package, and we will be very glad to be critical or complimentary as the cards fall, but we wish you the best of success with this leadership effort. Thank you very much.